So some highlights from the report. We've seen credit demand. They're still being out there with all banks being able to increase their loans and advances. And then on the rising interest rates, we've seen the endowment effect with the banks benefiting from higher net interest income. Then we've seen a digital transition where the banks were able to manage their payroll costs and then also reduce floor space while the IT expenses increased at a rate higher than their revenues. So this leading more to a digital approach. The market has seen a couple of low-cost entries, such as your Time Bank and Bank Zero. And then there's the thematic ESG funding, which all banks have set their own goals, although some of these goals are quite a bit longer term. On a valuation perspective, we've seen the valuations coming down after COVID with the rest of the market, and then these valuation multiples have started reverting back to the mean, but they're all sitting still at a discount if you look at it a longer, like a 10-year or a 5-year basis. And then on a consumer view, we've seen that the consumers are still holding up nicely in the sense of they look healthy in their debt service cost to disposable income and their built up cash balances. But we do just also take note that most data released is with the first quarter of the year, and we'll have to take a close look on the latest data coming out. Seeing as interest rates increasing more rapidly from May, we might expect the pressure only to come in the next couple of quarters. Looking at the historic profitability of the banks, so on a return on equity basis, if you look at the red line representing ABSA, it was usually above Standard Bank and Nedbank, and then in 2016 came below, and then reverting in 2021 back above them. Now we and other analysts are forecasting for the following 3 years that ABSA should remain above them. And taking this into account and moving to the next chart, we again plotted the forecasted return on equities, but then on the horizontal axis you'll see that we compare it to the price to book ratio. Now ABSA has a higher return on equity as just mentioned, but it's at a similar price to book ratio as Standard Bank, possibly representing a fundamental pricing mismatch. Going back to the loans and advances growth that I've mentioned, as mentioned, they all have seen growth, although in the SARB BA 900 reports that we also keep an eye on, we've seen that ABSA and FirstRand and Capitec was able to grow at the largest rate. I know in the latest results, FirstRand also mentioned that their growth was unfortunately at the last end of the year, therefore not necessarily benefiting on the interest yet. But then you'll see ABSA and FirstRand, both the growth is mainly coming from the commercial side, and Capitec being more focused on households, the growth will there be from the household side. Then our view, we prefer currently ABSA and FirstRand. If we start with FirstRand, this is due to it being a high quality company with a return on equity above its cost of equity, and then also it's highly regarded with consumers. Then ABSA, being due to this recent increase in profitability, not only would you now benefit from that profitability, but also possible re-rating, as it should technically, if you compare it to peers such as your Standard Bank previously shown, it should re-rate higher.
Thank you very much for joining us today.